$47 billion disconnect. If you're tracking the decentralization of global derivatives markets, your eyes have undoubtedly been glued to Hyperliquid. Its native asset, HYPE, has pulled off an absolutely historic run, rocketing to a dominant $15 to $17.5 billion market cap and rewriting the rules of what an on-chain perpetual protocol can achieve. The noise on YouTube and TikTok is that the perpetual DEX war is completely over, that Hyperliquid has established a permanent monopoly, and that every other protocol is just a legacy fork fighting for crumbs. But if you turn off the social media chatter and run a cold quantitative query across the blockchain, a glaring structural anomaly appears. An on-chain exchange called Aster protocol has quietly been printing an absolutely staggering $47 billion to $48 billion in monthly perpetual volume, averaging well over $1.5 billion in volume every single day. Here is the absolute disconnect. Aster is pulling off these massive numbers while sitting at a circulating market cap of just $1.9 billion. That means Hyperliquid is trading at a staggering 8 times valuation premium over what is effectively the clear number 2 protocol by volume on the planet. Today we look past the influencer bias. We are doing a deep, critical dissection into the tokenomics, the code, the technical chart setup, and the structural moat driving Aster. Is this the most asymmetric valuation gap in the entire digital asset ecosystem, or is there a hidden catch? My name is Newell. Welcome back to the Signal and Noise podcast. Let's dive in. To understand why the market is currently mispricing this asset, we have to look back at the protocol's origin story. This isn't a random project that launched last week with a flashy marketing campaign. Aster has a deep, battle-tested operational history. In late 2024, an established derivatives platform called Apollo X merged with Asteris, a decentralized yield optimization protocol backed by YZI Labs. They pooled their user bases, combined their technology stacks, and rebranded entirely to Aster. The legacy protocol had a tiny market cap of roughly $40 million, but following the structural rebrand, an absolute liquidity wave flooded the system, causing its token capitalization to jump massively. The platform has now processed over $519 billion in cumulative volume over its lifetime, boasting a massive 1.7 million active users. This is where the technical architecture diverges from Hyperliquid. Hyperliquid achieved its dominance by building its own custom single-chain ecosystem. Aster, by contrast, operates an ultra-flexible multi-chain aggregation engine. It pulls and executes deep liquidity natively across the BNB chain, Ethereum mainnet, Arbitrum, and Solana, without forcing the user to endure expensive, friction-heavy bridging processes. When a trader logs onto Aster, they are interacting with a non-custodial, high-throughput backend that completely eliminates the traditional multi-chain fragmentation trap. It mimics the pristine user experience of a top-tier centralized futures platform while keeping custody firmly in the user's wallet. But let's talk about the real structural signal highlighted recently by elite on-chain intelligence agents like at AIXBT_agent. Because if you think Aster is just winning traders over with low fees, you are completely missing the economic paradigm shift. Aster has solved the single greatest problem plaguing capital efficiency in decentralized finance: idle margin inefficiency. The Hyperliquid/legacy paradigm. When you trade perpetual contracts on Hyperliquid or DYDX, you deposit standard stablecoins like USDC as margin collateral. While your capital sits there backing your open positions, it generates zero yield. It is dead static capital. The Aster paradigm shift. Aster enables you to use yield-bearing assets as active trading margin. You can deposit their native yield-bearing stablecoin, USDF, or their liquid-staked BNB derivative as BNB. While your ASBNB or USDF is sitting in the smart contract, acting as collateral for a high-leverage Bitcoin position, it is actively compounding a 10% to 20% annualized yield directly into your wallet from underlying staking mechanics and asset rewards. Let's view this through the lens of a professional market maker or a sophisticated delta-neutral fund. If you are deploying tens of millions of dollars to hedge positions or run market-neutral arbitrage, that 15% APY on your underlying margin is pure, risk-free additional alpha. Capital operates under the laws of fluid dynamics. It will inevitably flow to the avenue that offers the absolute highest risk-adjusted return. This collateral feature isn't a temporary marketing gimmick. It is a permanent structural compounding moat that turns idle margin into a cash flow generator. Now, let's put on our critical analyst hats. If the volume is this massive and the collateral engine is this elite, why is Aster trading at a mere $1.9 billion market cap instead of $15 billion? We have to look deeply into the tokenomics and supply distributions. The native Aster token has a maximum hard cap of 8 billion tokens. Currently, the circulating supply sits at roughly 2.58 billion Aster. This means approximately 32% of the supply is circulating, giving the protocol a fully diluted valuation, FDV, of roughly $5.4 billion. While this is a healthy structural cushion compared to many venture-backed tokens, it means there is an ongoing schedule of emissions and community incentives that will introduce gradual selling pressure over time. We must address the structural elephant in the room highlighted by independent research pieces on Backpack Learn. On-chain auditing reveals high token concentration across a small cluster of foundational wallets. While a significant portion of this is explicitly locked for protocol migration and long-term staking pools, any high concentration of supply requires close monitoring. If early entities decide to aggressively dump their allocations into secondary market liquidity, it can severely blunt the price discovery of the asset. This is the ultimate line in the sand. Aster is currently printing over $1.69 billion in 24-hour volume. The vital question we must ask is, how much of this volume is organic and how much is being fueled by temporary synthetic trading rewards? If the volume vanishes when incentives dry up, the protocol fails. But if it sustains above $500 million organically, professional market makers will permanently nest in the ecosystem. That is the make or break signal. Let's shift our attention directly to the price action. The Aster token is currently consolidating heavily on the daily charts, hovering in the $0.70 to $0.75 range. Aster has spent months grinding inside a beautifully defined, tight accumulation band. The $0.65 to $0.67 zone has repeatedly acted as a concrete institutional floor. Every single time sellers attempted to push lower, buyers absorbed it. Aster is currently compressing like a tightly coiled spring right at the top of this range, breaking out above its long-term descending channel and printing consecutive higher lows. In financial markets, valuation gaps do not close gradually over several years. They compress through sudden hyper-violent repricing events. If the market suddenly realizes that a $1.9 billion token is capturing nearly half the volume of a $16 billion market leader, the capital re-rating happens in a matter of days, not months. Technically, if Aster clear-cuts local resistance around $0.81, there is a completely clear liquidity vacuum pointing straight toward $1.06, with long-term targets scaling significantly higher if the 8 times valuation gap begins its structural compression. So, what's the final verdict? The signal. The digital asset space is plagued by valuation inefficiencies because the majority of participants trade purely on social media hype. Hyperliquid is an undeniable, spectacular powerhouse, but a protocol printing $47 billion a month with a built-in capital efficiency engine that pays you to post margin cannot be ignored by professional capital for long. The move: do your own research thoroughly. Do not just buy blindly. Monitor DeFi Llama, track Aster's daily trading volume, and verify if the platform is sustaining its flow above that $500 million organic baseline. The premium on monopolies is real, but the laws of capital dynamics state that the gap must eventually close. Stay sharp, stay focused. That's it for this deep dive edition of Signal and Noise. If you want to outrun the market, you have to find the numbers the crowd is actively ignoring. My name is Newell. Do like and subscribe. We'll see you in the next one.